Welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Ravi Jakhar, Chief Strategy Officer at All Cargo Logistics, joining in. Welcome to the show, Ravi, and a pleasure to speak to you and have you on the show.
It's equally my pleasure, Hiral, and good interacting with you.
Thank you so much, and pleasure is all ours. Ravi, to start off with, let's start what the macro picture is looking like for an industry like yours. With the recent geopolitical issues that we are looking at, especially in terms of Russia, Ukraine, what's happening to crude prices, transportation costs going up, and you have the China lockdown that has come into play as well. How are you seeing this entire perspective play out for the industry?
Yeah, so I think, if you look at the long-term view on the logistics industry, there are significant tailwinds, both on the global trade in the segment where we participate as a company, and also on the domestic side with the whole manufacturing push that's being promoted in the country and the consumption-led growth. So in the long-term story, there's enough tailwinds and there's great optimism around very robust growth for years to continue. If you look at some of these disruptions, be it the geopolitical situation in Russia and Ukraine or the lockdowns in Shenzhen, I believe those are more temporary bottlenecks, which would not really matter in let's say 12-month horizon also. Now, of course, there is that small risk of Russia-Ukraine war escalating into something bigger, but at least based on my personal judgment on whatever I read, that probability seems to be very low. It is largely likely to remain a localized conflict, and which at some stage will see some resolution. We've already read some positive progress on the peace dialogue between Ukraine and Russia, and I sincerely hope that happens sooner. But I don't see this escalating into a prolonged year-long situation or something which would go beyond the boundaries of Ukraine and Russia. So to that impact, there have been limited disruptions. Of course, there have been disruptions to trade to and from Russia. But if you look at Russia's trade basket as well, a significant part of Russia's exports and imports are with China, and there's no conflict or disruption on the Russia-China side. So from their perspective as well, they have some mitigation measures. If you look at over the last 5 to 7 years, they've significantly moved their trade balance towards what they consider as more strategic allies and partners. From our perspective, we do not operate in Russia or Ukraine, but yes, we do have some business, which we do in our Scandinavian countries, where we transport containers between Scandinavian countries and China that used to pass through Russia. Now, of course, there's been a temporary disruption. You cannot use the Russian corridor in the current geopolitical environment. So we have found alternate routes. Now it comes down south to Turkey and then moves via Azerbaijan, Kazakhstan, and moves into China. So some of these minor temporary disruptions would lead to some bottlenecks, some issues, but we do not see them escalating into a major crisis. And there was a fear that oil prices could go up to 150, 170, and that would have been a really huge impact because everything is linked to crude prices, right? Marine bunker fuel price would have led to significant escalation in freight rates from current levels. The diesel price hike in the domestic side would have led to significant inflation. But I think thanks to the way situation has been handled, the way global diplomacy has worked, if you look at the position taken by Saudi Arabia and some of the other initiatives have ensured that the oil stays in the double-digit number, and that's comforting. And I believe with some of these disruptions over, that should perhaps further climb down to what most people believe to be long-term sustainable averages of around $80 or slightly below. The situation on China, I would say, is even more restricted in terms of its time impact. The impact is severe, but it is temporary. So a city like Shenzhen being completely locked down, it's like the mecca of consumer electronics manufacturing, be it smartphones, Bluetooth speakers, or any other products. And it's been locked down to an extent that there's literally no movement out there, and there's been a significant disruption. But would this disruption last longer? I personally believe that it would not last longer. Currently, it has been announced for a week, and I do not see it going beyond maybe another week in the worst case scenario. And if you look at the numbers, it's not like there's been an out of control situation in Shenzhen. It's just been the China's policy of taking excessive precaution. So, on a lighter note to share, I think in Mumbai, we're all feeling comfortable that the COVID is almost behind us. and Shenzhen is in complete lockdown. But if you look at the numbers, the Guangdong province as a state has lower cases on a daily basis as of today than Maharashtra. And Shenzhen is like just about 100 odd cases, which is also now started climbing down. I think yesterday was some 70 odd. So situation is not out of control in that sense. Chinese government has been more precautious. And that is why there has been a complete lockdown. But with such extreme precaution, it also appears, going by the past experiences, there should again be a very temporary disruption. And also, the situation on the south, which is in Hong Kong, sometimes worries people that, what has been happening in Hong Kong might as well spread to Shenzhen. But those are two very different cities. Hong Kong is a city of old people in many ways. I think almost 20-25% people would be 60 plus. Shenzhen would be like under 5% with maybe average age in 30s. So it's a very different demographic. So in summary, the geopolitical disruptions seem to be, not going beyond a few months, hopefully, and the COVID disruptions are perhaps a matter of weeks. They do not have a risk of leaving behind a prolonged structural impact on the logistics. And therefore, the structural fundamental remains same. When you look at the global cross-border trade, there are two key things. The e-commerce traffic, the cross-border e-commerce traffic is growing extremely fast. And we also see that small and medium businesses are gaining more prominence in the international trade, which means that the smaller shipments are likely to grow faster than your larger shipments. That's one key fundamental trend, and that's something which works very well for us as the world's largest LCL consolidator. On the domestic side, all forms of logistics, be it B2C, B2B, warehousing, contract logistics, express, everything would see a significant momentum for the next few years, because both consumption and the manufacturing should see sustained growth. So I'm very optimistic about the logistics industry in India and at the global level as well.
Right. So overall, if you see from a business perspective, let's break it out, starting off with MTO as well right now.
Right.
How are the container rates sustaining? And clearly, if you see that, how is the sustainability of the current performance expected to look like from here on for the MTO business? And what are the key factors that could lead to margin expansion? And what's your vision?
Right. So, if you look at so there are two questions in there. I'll first speak about the industry trends, then how do they impact our business performance? Now, as far as industry trends are concerned, the freight rates were historically very low at levels wherein shipping lines were making losses. But then over the last decade, significant consolidation has happened. There are almost a dozen shipping lines that do not exist anymore, which used to be there maybe 10, 12 years ago. They've either, some of them have gone bankrupt, some have been bought over. There's been a significant consolidation in the industry. There are also regulations coming in on account of, the carbon footprint, be it about making more fuel efficient ships, moving towards renewable fuels, moving towards slower speeds to reduce the fuel consumption for the cargo miles carried. So all these initiatives and the consolidation of the industry would mean that we do not see a scenario wherein freight rates would go back to what they used to be in 2018, 2019. However, the current levels are also higher on account of trade imbalances. So United States, which suddenly became a huge consumer of goods as the services got restricted due to COVID, led to trade imbalance. And there were many other factors which happened. Those factors would get normalized. And therefore, the freight rate should continue to normalize from the current levels. We were in fact expecting that they should have started to normalize and going downwards now. It would have gradually gone to a new normal, which would be somewhere in between the current rates and the historic rates. And that perhaps has got pushed by a few months because of the whole geopolitical situation and leading to uncertainty and again some trade imbalances. But directionally, the ocean freight rate should come down and settle at somewhere in between what could be a new normal. In terms of the impact on our business, the large part of our business is LCL consolidation, which means that we act like an Uber of shipping. We have fixed scheduled departures across 2,400 direct trade lanes, and then there are many transshipment services as well. This means that we might be having a fixed weekly or a daily service between different port pairs, say Hamburg, Busan to Hamburg, for an example. And in these trade lanes, we run scheduled services. People can book 1 cubic meter cargo as well. And being a fixed departure, it's almost like they don't need to fill in the entire container. And this is a consolidation business where we run the world's largest and the most complex LCL network. So our value lies in running that complex LCL network. And ocean freight, to that extent, is almost like a pass-through cost. As the ocean freight rate goes up, we pass on those costs to, as we move in, as we, let's say, pay to the shipping lines for the box, and we charge customers for the cubic meter carried inside. So it's almost like a pass-through on the LCL side. So the bottom line does not really get impacted in the LCL business, which is our mainstay business in the international supply chain. What truly drives our profitability is efficiency. How much cargo can we carry in that box? Because, for an example, imagine we carry a 25 cubic meter cargo in a container. Now, if we can increase that to 25.75, that's like 3% additional revenue that the company can earn without incurring any significant additional cost, because your cost side is fixed on the box level. So in the LCL business, our driver is mainly efficiency. On the full container load business, there is some impact of the freight rate. So therefore, as the freight rates go downwards, there should be some shrinkage of margin, but that should be more than compensated with the volume growth that we have demonstrated over the years. If you look at the FCL business, we have grown almost 7 times to 8 times over the last 7-8 years. So
right.
Yeah,
so what would the vision be in terms of the MTO business? What's the kind of growth, margin expansion that you're expecting, taking into consideration that a lot of digitization is happening? There could be cost saving initiatives as well on the back of the same.
Right. So first, our strategy is to drive organic and inorganic growth, continue to make our network more robust. Today, we control almost 14% of the neutral LCL consolidation market globally, and the aspiration is to continue to drive that upwards, which means that we continue to grow faster than the market growth rates. Now, with these additional volumes, we are in a position to improve our utilization of boxes, and we're also using technology. So today, we're using data science tools to drive yield optimization. We have a separate function which focuses on yield optimization. So those things would lead to more operating margin improvements. And then below that, what we're doing is we are digitizing all the customer touch points by engaging customers digitally, and we are automating the backend operations, which means that we can sustain a robust growth on top of the current business without having to invest in too many additional office spaces, people, or physical resources. And if you look at the margin profile, the SG&A costs are significant, part of our gross margin. So as we are able to control those costs and incremental revenue comes in, we should be able to see a operating leverage at play as well. In terms of progress, I would say almost 90% of the processes have been standardized, and a large number of them have been automated using document AI and other technologies available. On the customer touchpoint side, we perhaps had about 8% utilization. 8% of the bookings were coming in through our EQ360 platform 3 years ago. We have taken a significant leap there, and today, more than half of our bookings are either coming in through EQ360 or our digital interface. So that's a pretty substantial number in our business to have that share of bookings coming in through digital channels. And that's something which positions us very well to continue to improve the operating margins and the underlying bottom lines as well. However, like I said, freight is a pass-through cost, right? Which means that when the freight goes up, because we're not proportionately increasing our margin, so the percentage margin would appear to have a slightly negative impact. While when the freight rates go down, our ability to hold back the profits would mean that the operating margins can go up. So I would say when you look at the margins as a percentage of revenue, they could be a little bit misleading. But if you look at the gross profit to EBITDA margins, which is or gross profit to per cubic meter volume, those numbers should continue to grow well for us, and we're optimistic on that.
Right. Ravi, coming to contract logistics as well. Currently, I think 5 million square feet is something that you're managing. Plus, you have the Gati acquisition as well. So clearly, there is growth that is anticipated on that front. If you could just help us understand, firstly, what's the scale that we're looking at over the next 2 to 3 years? Secondly, on the same front, In terms of Gati as well, are there any plans to increase our all cargo stake in Gati? And what would the integrated offerings be? I mean, how would the offerings be integrated?
Right. So here, if you look at the contract logistics business, that was our first serious foray into the domestic logistics industry. We acquired a company back in 2016. And with that, we got a legacy business of contract logistics focused on chemical industry. But today we have expanded the portfolio significantly. Today we operate in e-commerce, auto, and other segments as well. Obviously, in chemical industry, we are market leaders in the country, while other segments are still in different phases of growth. But if you look at the opportunity at hand in contract logistics, that's humongous. Like I said, beyond chemical, in the other sectors, we are still a nascent player. There's a huge headroom for growth. And we have seen a consistent increase in our square feet under management over the last 3 to 4 years. And that is translated into growth on the financials as well. We're very confident of that momentum to continue for a good period of time in the years to come. And express business is also somewhat related to this. And that's how our second foray into domestic logistics came in by way of Gati acquisition. And with Gati acquisition, the first target was to transform the company. And I would say that we have concluded the transformation program with good satisfaction. We've been able to bring Gati back on the growth path in terms of, it used to be losing market share. Now we've come into a situation of retaining and growing market share. We have reduced the focus on non-core businesses. A lot of businesses have been divested. The company management is now sharply focused on the B2B surface transport business. We've gotten several prominent industry leaders and professionals who are now driving the company. The debt has been brought down from over 400 crores to under 200 crores. The operational efficiency is significantly improved. The business that used to be operated with more than 5,000 people today operates with less than 500 people and still doing historically record volumes. Digitization initiatives have been working very well. Our partnership with Salesforce to drive best-in-class CRM tools. So there's been a lot of positive progress in terms of bringing, good order in operations at Gati, and that's something which is being done. And now from here on, the impetus would be on driving growth and expanding the market share. So we're very optimistic about both express and contract logistics. Because if you look at the express logistics, also the growth is driven by two key factors. One is the growth in the consumption and the production itself, and also the shift from slow speed, unorganized transport to time-bound express logistics. So the express logistics as an industry is growing very well. And the second structural shift that we see is in the e-commerce domain. So what we notice in e-commerce is that maybe 5 years, 7 years ago, there were limited number of warehouses that Amazon or Flipkart would operate, which means that if somebody is ordering, a product from these websites, that product was perhaps being shipped from a faraway warehouse and it was moving in a B2C movement. But now as these companies are making a much more widespread supply chain with warehouses near to the consumer, it means that the first leg of the transport, which is from producers to these warehouses, is increasing more rapidly than the overall e-commerce growth, because the e-commerce growth is driving that, and also at the same time, the percentage of that movement within the e-commerce is growing. And that's a business which is the ideal business for Gati as well, to make use of our B2B capabilities. And so that's another driver of growth. So this is, again, I would say, after the international supply chain, this is the second broad segment wherein we have contract logistics and express logistics business. And we're quite optimistic about both.
Right. And Ravi, coming to CFS as well, what is your plan on that front in terms of developing the ancillary business around CFS? Say, when we're talking of participation, the DFC, or in terms of the multimodal logistic parks, or the coastal side of it as well, and what's the growth strategy there?
Right. So, coming to container freight stations, and which brings us back to the discussion on EXIM cargo. If you look at the whole focus on, the China plus one story, the government's policy push for manufacturing, there are enough reasons to be hopeful about significant expansion in India's EXIM trade. And that means that there should be a great opportunity for container freight stations in the country. We have done a strategic acquisition last year, which now puts us comfortably in the market leadership position. And we are present across all the key ports. And most of the growth going forward on the CFS side would be organic growth, except for maybe some small strategic acquisition that we may undertake. But beyond CFSs, the other opportunity which is emerging and which we are looking forward to participating in is on the ICD side. Now, if you notice, the DFC has been work in progress for many years, but now it appears that by end of next year, hopefully it should be fully commissioned. And DFC would be a game changer in logistics. Today, there's been a huge shift from rail freight to road freight over the last decades, right? Road freight has become much more faster, efficient. But now the dedicated freight corridor coming in, your goods trains which are running at 30 kilometers speed would now be running at 60 kilometers. You would be doing double stack electrified. You would be perhaps able to run, twice longer trains. So think of 4 times containers being carried at 2 times the speed. And it's a great mode of transport. Electric rail locomotives have a very significantly lesser carbon footprint. So it's a very sustainable form of logistics. And we believe that alongside the key routes where dedicated freight corridor is coming in, there should be a significant shift back from road to rail. And we as a company are focusing on the Northwestern Corridor. We have an ICD coming up at Jhajjar, which should allow us to cater to the users in the NCR region, and it would be connected with the DFC. Beyond this, we are also looking for other locations on the Western DFC to identify how we can cater to the requirement of container handling terminals, both for domestic in terms of private freight terminals, which could even handle bulk cargo as well, and on the container side. So ICDs is a new opportunity for us, and we would be fully aligned with the DFC in our strategy on that.
Right. Overall, Ravi, if you have to talk about the demerger, what are the timelines that we're looking at on the demerger as well?
So on the demerger, we got the board approval in December, and currently it is going through the subsequent process, various stock exchange approvals, etc. And then the scheme would be filed with NCLT. Our estimate is that it takes between 12 to 14 months. And so counting from December, sometime around January to February next year, we believe that the demerger should get completed, and which would lead to creation of 2 new entities, all cargo terminals, which will house the CFS ICD business, and Trans India Realty, which will house the real estate part, logistics parks, and the equipment business.
Right. And currently, the cash flow remains pretty strong. What's the deleveraging strategy from here on? How much are we looking to deleverage in the next, say, 12 to 24 months?
Yeah, so I think, we have very robust cash flows, which currently are being put back into driving growth, both organic and inorganic. So if you look at over the last couple of years, we've acquired Gati, we've acquired Nordicon, we've acquired Speedy Multimodes, we've done quite a few, we've done a joint venture in Korea. So we have done significant acquisitions, which have allowed us to grow without, leveraging too much. We've been able to repay debts through internal accruals. And we believe that the cash flows will continue to remain strong. We have also used the cash flows towards expanding the business. If you look at the growth we have had in the international freight business, the working capital expansion has been significant, which we have been again managing without increasing the leverage much. As we go forward in a more stable ocean freight regime, the cash flows will be more robust and would support us in deleveraging significantly. So I would believe that over the next 12 to 24 months, as you asked, we are likely to have only short-term working capital limits or real long-term loans such as LRDs, which makes sense when you look at a warehouse leased out to a client for 10 to 11 years. It makes sense to raise an LRD on that. So those are the kind of debts that we would like to retain, but otherwise most of the other debts should be completely eliminated with the growth in strong cash flows.
Right. And very lastly, Ravi, overall, if you have to look at growth milestones, over the next 3 years, what is that expected to look like? What's the growth that we're targeting? and any top line or bottom line number that we are looking to, achieve in the next 3 years?
Yeah, so I would say, if you look at one clear focus from our side has been to cut out everything which is not core. We've closed down cold chain business. We have exited some other businesses as well. So that's something which is, a constant work in progress. Whatever remains behind is, is the core business that we have. And in this core business, we are confident of gaining market share, which means that the top line would grow at a rate faster than the market growth rate. Now, what are the growth rates for the underlying markets? If you look at the international supply chain, this would be, so typically the LCL business should grow at anything between 1.5 to 2 times the global trade growth. And so therefore there should be a good strong growth there. The express industry in the country and contract logistics, various industry estimates put it at 15 to 20% kind of growth rates for the years to come. And the container freight stations is a direct correlation with the India's EXIM trade. It may continue to witness strong growth as well. And on top of these numbers, like I said, if we are expanding our market share, naturally that means that we would grow faster than that. So that's a broad guidance I can share with you.
Absolutely. So look, the road looks much faster. I think it's at the same pace that the coastal roads in Bombay are picking up. I think that's the pace that you're picking up as well in terms of growth. But thank you so much, Ravi, for joining us on the show. Always a pleasure. In fact, good insights about the business that we've got today as well, and about the industry from you. Thank you so much. Stay safe and speak to you soon again.
Thanks, Cyril. Truly pleasure interacting with you today. You too stay safe. Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.